Welcome to Alamut Capital Knowledge Center. Today, topic of discussion is, what is diversification and why diversified portfolios fail to work for most investors? Diversification did not fail in 2008, 2020, or 2022 because investors forgot to buy enough asset classes. It failed because portfolios were diversified by label, not by how positions actually move together. Most investors believe that owning domestic equities, international equities, bonds, and alternatives automatically creates safety. In theory, this works. In practice, it often fails, especially when diversification is needed the most. And the reason is simple. Diversification is not driven by asset class labels. It is driven by correlation, and correlation is neither static nor reliable across time. Traditional portfolio construction starts with asset classes. Stocks behave one way, bonds behave another, and alternatives are expected to smooth returns. This framework assumes that assets within different labels will move independently, but that assumption only holds during calm market environments. When stress enters the system, correlations rise. Assets that once appeared independent begin moving together, often sharply and simultaneously. The result is that portfolios constructed to reduce drawdowns experience losses across nearly all allocations at the same time. Diversification fails not because it was poorly implemented, but because it was built on static relationships that do not hold under changing market regimes. At its core, diversification is about how assets move relative to one another. Correlation measures whether assets rise and fall together, move independently, or move in opposite directions. What matters is not whether an asset is labeled equity or bond, but how its returns behave when risk conditions change. Crucially, correlation is dynamic. It changes with market regimes, macroeconomic conditions, investor behavior, and volatility. A portfolio built on historical correlations assumes tomorrow will behave like yesterday, an assumption markets repeatedly invalidate. True diversification requires understanding and managing these changing relationships rather than relying on static allocation models. History provides clear examples of correlation breakdowns. In 2008, equities across regions collapsed together, credit markets froze, and even traditionally defensive assets failed to provide protection. In March 2020, global equities, commodities, and many alternative strategies sold off simultaneously as volatility surged and liquidity disappeared. In 2022, rising inflation and interest rates caused both equities and bonds to decline together, breaking one of the most relied upon diversification assumptions in modern portfolios. Correlation is not random. It is driven by a combination of structural forces that evolve over time. First, risk factors play a critical role. Assets that share exposure to common factors such as market beta, momentum, growth, or liquidity risk tend to move together when those factors dominate returns, regardless of asset class labels. Second, macro regimes matter. Inflationary environments, deflationary shocks, tightening financial conditions, and economic contractions all reshape how assets interact. Correlations that appear stable in one regime can reverse or intensify in another. Third, volatility acts as an amplifier. During periods of rising volatility, diversification benefits compress. Investors de-risk simultaneously, correlations spike, and asset prices converge downward. Because these drivers evolve, assets that were historically uncorrelated can suddenly behave as one, while assets within the same category may diverge based on differing exposures. A quantitative investment framework does not begin with asset labels. It begins with behavior. At Alamut Capital, diversification is approached by analyzing how assets respond to changing regimes, factor exposures, and volatility environments. Portfolios are constructed to adapt dynamically, adjusting exposures as correlation structures evolve rather than remaining fixed to historical norms. This allows diversification to be achieved not only across asset classes, but also within similar assets that exhibit different risk characteristics. The goal is not to eliminate risk, but to manage it intelligently as conditions change. Diversification is not dead, but static diversification is insufficient. Effective portfolio risk management requires moving beyond labels and toward a framework that recognizes correlation as dynamic, regime-dependent, and behavior-driven. By focusing on how assets actually move together and why investors can build portfolios designed to withstand stress rather than fail when diversification matters most. If you want to understand how institutional-grade, quantitative risk management works in practice, explore our research and investment framework at alamut.capital.